Hey, welcome to this week's video. In this week's video, we're going to talk about business receipts. You see, while the law may not always require receipts, the law always requires proof. If you don't have receipts, you have to prove your expenses in some other way, which means possibly trying to reconstruct your records years after a purchase may have been made. And that can be a headache, right? You will make your life much easier if you keep receipts, as well as some other information which we will discuss in this video. So let's get to work. You see, the IRS requires proof of at least two things for all expenses. The first is how you spent the money. The second is the business purpose for that expenditure. And receipts do a great job of showing exactly how much you spent. The business purpose usually speaks for itself. For example, if you're an auto shop, the IRS is not likely to question your purchase of motor oil. However, if it's unclear how the expense relates to your business, you should make a note of the business purpose. For example, a purchase from Amazon doesn't really tell you the business purpose for that expenditure, so a receipt can serve to document the business purpose. Credit card statements and voided checks are good records to keep and can be used in place of receipts. But the downside, as I mentioned earlier, of these documents is that they only show you how much you paid, not what you bought, nor the business purpose. For example, if you go to Walmart, you might buy some items for your business and also pick up a few things for home. A credit card statement for the purchase would only list a lump sum payment, and you would have no way of proving how much you spent for business items and how much you spent for personal items. The receipt, however, breaks down exactly what you bought and allows you to prove the business purpose of each item. That's why keeping the receipts is a great idea. However, if the IRS questions the validity of the receipts, your credit card statement provides proof that you spent the money as you claim. So it's a good practice to keep the receipts to be able to show that you bought the item and to be able to prove the business purpose for that item. Okay, I get this question a lot. You don't need receipts if it's less than $75. Well, the IRS does not require that you keep receipts for vehicle, entertainment, meal, gifts, or travel expenses that cost less than $75. Everything else, though, you need a receipt or some kind of proof. That's nice, but you must also prove, in some cases, depending on the expense, the date, the amount, the price, the business purpose, and, in some cases, the relationship. The receipt gives you most of the information you need. But let's say that you're having a meeting and you want to expense that meal expense. You'll need extra proof of the name of the person that you ate with and why you met with this person or the purpose. So why not keep the receipt and write the who and purpose on the receipt? Also, if you are using cash to pay the expenses for which you don't need receipts, the IRS might want to see a nice audit trail that shows where you got the cash for those less than $75 expenses. All other receipts are needed regardless of the amount. So the $75 rule, again, only applies to vehicle expenses like fuel, entertainment, meals, gifts, or travel expenses. And remember, if it is not clear what the expenditure was for, like earlier when we talked about Walmart, keeping proof that the expenditure was business related is critical. So why not just keep that receipt? All right, so let's talk about some examples. So you don't need a receipt for a $65 business meal, but again, remember you need the name and the purpose. You do need a receipt for that $35 business industry subscription. You don't need a receipt for $45 spent on fuel, but remember you need to track your miles for your business. And you do need that receipt for that $17 calculator that you purchased for your favorite accountant. So as you can see, the rule you have to remember, when you're buying something. Do I need this receipt or don't need the receipt? It might be best just to keep the receipt. So let me ask you a question, true or false? Canceled checks and credit card statement are sufficient records. The answer is false. Although I mentioned earlier you could possibly be able to utilize a credit card statement or canceled checks if you ever did get audited, but really you do need the receipt, and although they help, you really are required to have the receipt in certain circumstances. Okay, another true or false question. For meals, gifts, and travel, I don't need anything if it's less than $75. This is false. Remember earlier I talked about that if you're going to expense a meal, you need to have the name of who you met with, and that you need to write down the business purpose. And also, for example, mileage, if you're expensing fuel, you have to be able to write down and keep track of your business mileage. Okay, another true or false. Use of my accounting records are enough to prove the deduction. Answer is false. Really, the records are great to have and it's a great source of proof, but you really do need the receipts. Again, one thing you could do in a lot of accounting softwares is you could attach the receipts to your system, and that way you don't have to keep the receipt. And I'll talk a little bit more about scanning receipts later in this video. How about this? I can use cash to pay for expenses. Well, that is true. You definitely can use cash to pay for the expenses, but I would avoid paying in cash. Cash really is kind of so 1990 anyways. As a general rule, don't pay in cash. These are the first questions an auditor will ask when they see a cash payment. They'll ask, where did the cash come from? How good is the trail of cash for that payment? Was an ATM withdrawal evident before the cash payment? Did the taxpayer really spend the cash or just make up this deduction? You'll face no such questions for payments made by check or by credit card. So now let's talk about electronic copies. I know keeping receipts are a pain. I totally get it. Also, receipts can fade over time and the IRS audits occur a year or two longer after you submit your tax return. By the time the audit happens, your proof may be hard to read. You don't want to let that happen. A good way to avoid this is to scan your receipts. Like arrange a time periodically to scan your receipts, maybe every 2 months or every month. This also helps you organize your records electronically and save some space. Once you have an electronic record of your receipt, you don't need to keep that paper copy. A better way is that you can use one of the many apps that are available for this purpose. Heck, QuickBooks has the feature built into their app, and there are programs that do this like HubDoc, there's Dex, there's Shoebox. These programs sync with QuickBooks and other accounting software, and in some cases attach the receipt automatically in your accounting program, and that makes it a lot easier if you have to ever go back and look at that expense. It'll be attached in your accounting program. As an auditor, I can tell you this makes things much easier if you ever do get audited, and tells the auditor that you're not hiding anything and you have kept excellent records. But scanning every receipt and attaching into your accounting program can be a bit of a pain, and let's face it, the chance of audits are low. So what you could do is use apps like Evernote or maybe OneNote to quickly scan and store those receipts. Maybe you do this once a month or ever so often. And if you do this, you can scan them with a reference to maybe the month and the year. This way you can easily find the receipt if you ever have to go back to it later. So if you're a small business and you don't have a lot of receipts, this might be a good way of doing that versus scanning everything into your accounting software. Okay, so to wrap up this video, here are some key takeaways from keeping business receipts. Remember, the IRS does not always require receipts for business expenses, but it always does require proof. So receipts are wonderful because they contain most or all of the information you need, and you don't have to work to prepare the document. Someone else created it for you. All you have to do is store the receipt in a safe place where you can find them later. For some types of expenses, the IRS requires you to note extra information on the receipt, as we mentioned earlier. A great habit is to scan your receipts, and there are many options to help you with this. And the IRS treats electronic images exactly the same as it does paper originals. We help many of our clients manage receipts this way, and it works really well. Heck, this might be a great job for your child to do and make some extra cash while giving you a tax deduction. And I have another video on that as well, which I'll link into the description. Also, you may want to see receipts at a later date when reviewing your numbers, and it is helpful to have this stuff easily organized. We also help our clients with this as well. And the reason you might want to do it is if you're reviewing your expenses, you might want to see what that expense related to at a later date. And if you have that scanned or it's scanned in your accounting software, it is there for you to be able to see. So that's it for this week's video. If you got any value out of it, it'd be great if you hit that thumbs up. And if you haven't subscribed, it'd be awesome to have you as a subscriber. So I'll catch you on the next one.